We're speaking with the management of Go Fashions. We've got Gautam Saraogi, who is the ED and Chief Executive Officer of the company, joining in. Gautam, thanks so much for taking the time. Top-line growth quite significant in the quarter gone by, 15%, EBITDA growth of 13%, but the PAT has shrunk marginally, and I think that's on account of a shrinkage of or contraction in the EBITDA margin. Can you take us through the key highlights as they stood out to you?
Yeah, hi. Thanks for having me on the show. I think this has been a good quarter for us. We've reported a good top-line growth of 15% on a YOY basis. In fact, this quarter, we've also seen an increase in our gross margins. We've seen a 100 to 150 bips increase in our gross margins. But however, our operating margins have taken a small hit this time around. That's largely because of our same-store sales growth being flattish. And because our same-store sales growth has been flattish, the cost in those historical stores have been slightly higher this quarter as a percentage of revenue. And that's why we've seen our operating margins taking a hit to the extent of 200 to 250 bips.
What you're saying is that the new stores that you're opening are effectively more efficient than the earlier stores? Is that how to understand this?
No, that's not the right way of looking at it. See, the new store, usually when we open a new store, it goes through a maturity period. So the new stores what we have opened during this quarter have done fairly well. It's just that the historical stores what we have not seen a big revenue jump on a YOY basis. It's been flattish. And that's why the costs in such stores have been higher.
Understood. But there is quite a substantial increase in the number of stores you're introducing as well. As I understand it, you are planning to add as many as 120 to 130 every year. What is the kind of cost that you're setting aside to set this up, and how many are you planning to open in the last quarter?
So see, our original plan for this year was about 120 to 125 stores. We will be falling short of that a little. So we would be ending up with 105 to 110 stores net additions this year. Last year, we had opened about 120, 125 stores. For a very long time, we've been opening 120 stores every year. We feel there's a large runway for the number of stores we can add. Today, we are at about 700 stores. As a brand, we see opportunity of having more than 1,500 Go Color stores across the country. So keeping that large vision of number of stores in mind, I think 120 plus stores a year is a good, healthy number for us in terms of additions.
You've explained why there was a bit of a contraction in the EBITDA margin, but I'm also curious about the finance costs, which on a year-on-year basis have risen quite a bit. What explains that?
See, this finance cost is nothing but actually rent. See, according to India's 116 accounting standards, we need to show our rental expense as depreciation and interest. So effectively, there's no finance cost in the business because we are having cash in the balance sheet. It's just that according to India's 116 accounting standards, we have to show rent below the line in depreciation and interest.
Understood. Another factor is a 29% increase in the other expenses. What does that consist of, Gautam?
So this other expenses has been largely because in quarter 3, we had higher advertising spends in quarter 3 on a YOY basis.
Okay.
If I take a 9 months comparison with last year 9 months comparison, our advertisement cost has actually been lower. But as an individual quarter, we have spent a little higher on advertising in quarter 3.
Okay. Now, going back to the mix, and I see from your presentation that about 3/4 of your sales takes place through the stores that you open, and only less than 3% is through online sales. Why is it such a small amount that is in online, and is this part of the strategy going forward as well? Are you not going to be thrusting too much towards online?
No. See, online is a very important channel, and very rightly you asked. See, we are seeing a more than 30% growth on a YOY basis in the online channel. Currently, our online channel is very small because of the number of colors we are offering in a product category. See, we are having more than 100 plus colors. So consumers find it very difficult to identify and match those shades on a digital screen. Okay. But having said that, the channel is growing very fast. Today, we are probably at 3%. Maybe after 4-5 years, from a revenue mix perspective, online will be 7-8%.
7-8%,
but offline would be largely our largest channel because of the kind of colors and product category we are in.
So, but I'm just trying to understand the scale of this, right? If you're saying 3% right now of the sales mix, and it will maybe triple to the most that it can grow in 4-5 years, but the base itself is going to grow, or the pie itself is going to grow for you, right? The revenue. So I'm just trying to understand how that is going to progress. If you're adding about 100, would you say another 100 stores next year? So can you give me a perspective on how you expect the sales growth to happen as well?
Yeah, see, so next year also we are going to be adding 120 plus stores next year. From a sales perspective, next year we would be looking at a 20% plus growth. See, usually if you take our last history of so many years, we have been growing at 20% plus growth. This year, growth has been muted because the overall demand environment has been a little soft. So on a long-term basis, we are going to continue to grow at a 20% plus CAGR.
And
From a revenue mix, from a revenue mix perspective, today our own stores are contributing to about 73 to 74% of our business.
Yeah.
In the long term, we see our own store sales going up to about 85%, online coming to about 6-7%, and the balance would be the other channels.
Okay.
This I'm talking from a longer perspective, not short term.
Any costs involved in ramping up capacities at all, or is this more or less going to be funded through what you have right now, or not funded, but then the growth that you have, is it going to be based on what you have right now?
No, see, I think, look, our business has been generating good operating cash flow.
Yes.
I think this year, for the 9 months also, we have generated about 80 to 90% of our operating EBITDA we have converted into operating cash flow. So our operating cash flow is very strong and is good enough for us to support the expansion. We see over and above an expansion that we will generate free cash.
Fair point. Pleasure speaking with you, Gautam, and thanks for the insight that you've given us today, and look forward, of course, to talking to you at the end of the financial year as well.